Hi Tricia, thank you so much for joining us here at IMpower. It's great to see you. You've been talking about the position of private markets at the moment and how that's evolved over the challenging period we've been in. What have you seen?
Hi Emma, firstly thank you very much for having me to speak with you today. So yes, as it pertains to private markets, it's a little bit of a cliche, but the intention of private markets is that it's uncorrelated to the public markets. So obviously there's been a huge amount of volatility and concern as it relates to Ukraine, as it relates to inflation and monetary tightening. But as yet, the impacts on the private markets asset classes have been relatively muted.
So what evolution are you seeing in terms of what people are looking for in that climate that you've described?
So it really depends on the client and the client's objectives and their current positioning. So if you have clients that are looking for growth, then they typically continue to look to invest in the private equity markets. And there's ever more interest in the venture capital market, but again, that's further up the risk spectrum. I think what's important to focus on as an asset class specialist and as a manager researcher is the quality of the investments that the managers are making. So we're seeing the amounts of capital raised increasing, the amounts of capital that then needs to be put to work increasing as well, and there's increasing competition. So from our perspective, it's very much about focusing on how the manager deploys, where they deploy, and the quality of the underlying assets, and being very conscious of the deployment not being too fast, so that trade-off between speed and quality.
And also, are you seeing other demands and factors in there? Are people, obviously we're talking a lot about sustainability this week, are those elements coming into play as well, what people's expectations are?
Definitely, yes, without shadow of a doubt. So at Redington, we expect all of our managers to incorporate ESG principles as a natural risk factor in the same way as they'd address other risk factors. Sustainability and ESG needs to be incorporated in there as well. But taking that a step further, there's also an increasing focus on impact. So when we talk about impact, we're talking about investments that are made specifically to have either a positive impact on the climate and the environment, or to have a positive social outcome.
That's really interesting. And do you think that's one of the outcomes of COVID times? Because I think that did draw so much attention to the state of our world and how we all live, didn't it? So do you think that's brought that to the fore more? Particularly the S, perhaps, of the ESG as well, which has sort of been the poor relation to the E in terms of people addressing that.
Yes, it's definitely crystallised and kind of brought home the requirements of kind of looking after our climate and looking after our people. And I think there's definitely a skew towards climate in Europe and a skew more towards kind of diversity and inclusion in the US, but they're gradually bringing those two universes together. And from a manager perspective, again, we've got managers that are very different parts of their evolution, and it depends by asset class as well. So typically you will talk to a credit manager, particularly distressed, for example, and they'll say, or they may say, well, that's out of our control. Historically, they'd have said, nope, the equity owners are the ones that can make a difference there. Whereas from our perspective now, we expect all of our managers across the different asset classes to be progressing along that ESG journey, albeit that the asset classes are at different stages. So from our perspective, we don't set official benchmarks that we expect managers to reach, but we do ask them to measure and to report on the stage that they're currently at, so that they're setting that bar, and then we can help them raise it as they go forward. I think one of our main concerns is that everyone talks about the 2030 and the 2050 decarbonisation objectives, and they're quite a long way away. And some people will say, well, that's beyond my career's length. Whereas we'd say, we want to see the short-term actions and milestones now to help reach those long-term objectives.
Really interesting. And how do you see the picture changing in terms of private markets going forward? Where do you see the opportunities with all that background that you've just described?
Yeah, so there's a lot of opportunity, but then I'm an asset, I focus on private markets. So I think coming back to your original question about what's been evolving and what are people finding interesting. So there's a much greater focus on private credit as an asset class. So here we're talking about non-traditional bank lending, but it doesn't necessarily mean that it's superbly complex. It's just that there's a gap as it pertains to who can provide that financing. And what's really attractive today in private credit amongst this backdrop of inflation and rising rates and volatility is that you have typically contractual cash flows, you have a floating rate, so you're protected from that volatility in interest rates, but also in a lot of the scenarios you have assets behind your loans, so we call them asset-based loans, and that's not purely structured credit, but it can just be that you have operationally important cash flows behind those loans or operationally important assets. So that's definitely a focus. Fitting in with your question about ESG and sustainability, very much a focus is infrastructure, so infrastructure equity. And we've spent a lot of time monitoring the evolution of infrastructure as you go towards the green transition. So we initially started looking at creating renewable power assets and creating the power, and then it was talking about storage, and now for us kind of phase 3 is energy efficiency. So how do you reduce the loss of energy? So for example, that can be making sure that power is produced closer to the point at which it's used, for example.
I can tell just by speaking to you that you're really excited about what part you can play in that, and it's really great to see. You must be looking forward to having those conversations at an event this large this week.
It's great, yeah, no, it's fantastic, because one of the things in private markets that really resonates with me is the real world impact. So people talk about the green transition and net zero portfolios, and there is the potential in liquid markets and in public markets to, I guess, use an exclusions process so that you can take out the kind of sort of slightly more dirty assets, and then your portfolio looks clean and you're transitioning towards net zero. Whereas in the private markets world, you are building renewable power stations, you are helping create affordable homes, and so it's just much more tangible, and you're really having an impact on that ultimate objective in the real world.
Rather than taking away, you're taking action, if you like.
Yeah,
So
you engage, that's everything that we're about. It's kind of engagement with our managers, and then we want our managers to engage with their borrowers and their companies, and then naturally on the other side, we're engaging with our clients as well, and you know, they've got their requirements and their demands, and then we'll try and help them meet those objectives and try and, you know, educate them along the way as well.
really interesting times for you, Tricia. Thank you so much for sharing your insights with us here at IMpower this week. Great to talk to you.
Thank you very much for having me, Emma. Thank you.